Hey, everybody. Welcome back to Investing Unscripted, where we ask the hard questions about investing. I'm Jason Hall, joined by my good friend Jeff Santoro. Some of you may know him as the voice of the people. Hey, Jeff.
Hey, this is a very formal introduction to a rough cut.
Yeah,
Is it
you're
because you're
right.
wearing a tie?
Well, I'm getting ready to go to a funeral, recording this right before the market closed. My portfolio died today.
Ooh, that is a bad joke. I think we need to talk about the market because we recorded our most recent podcast a few days ago and talked about how August was off to a rough start because August 1st and August 2nd were down days for the market. But here we are on Monday, August 5th, and
It's the
it
downest
is
day of the year.
it is the downest day. Yeah. Uh, I think last time I looked, it was about 4% ish down for the S&P and for the Nasdaq.
Yeah. So
And
looking at Wall Street Journal, so there's a little bit of delay right now. The Dow is down 2.7, the S&P 3.2, NASDAQ 3.67.
so not crazy in its own right, but this is the third straight down day, the market day. And if you're on social media at all, you are seeing all of the hot takes. And what's interesting to me, I don't know if you've noticed the same thing. I'm seeing just as many people predicting doom and gloom as predicting, oh, the market will be up by middle of the week.
Yeah, yeah. And that's interesting because it's pretty typical of like FinTwit. I'm going to continue to call it FinTwit. Um, Typically, when we see these volatile to the downside days, there's lots of buying opportunity, right? Um, and this is whoa, this could get bad. And Jeff, I think that's just because well, investors sold into the weekend and kept selling. The pre-market was down bad and the market was down a ton more. Like my portfolio, just as an example, down right now, down about 2.6%. Um, it was down 6% at one point. I guess probably around 10 a.m. at various points.
Yeah, it certainly got less bad as the day went on. But I think what's interesting is it these are the things that were popping through my head over the last couple of days. Like obviously all the businesses that are in our portfolios that are now down cumulatively maybe 10 or more percent over the last several days are not that much worse of a business between then and now. But the flip side of that coin is maybe they were 10% overvalued before now, right? So there's two ways to kind of think about these down stretches in the market.
Yeah. One of the ways I think about it is, I mean, the market is very efficient at taking in information and factoring it into what it values any stock at. Doesn't necessarily mean that information is accurate or is going to prove to be correct. So obviously, what's happening right now is market was down the last couple of days last week on some economic stuff and the Fed um, holding firm on interest rates, even as we started to see a few other countries, central banks start to lower their rates. Economic data hadn't been great. The jobs report, right? That was um, definitely indicating a softening economy. You're hearing lots of calls for people saying that we're already in recession, maybe.
Hmm.
And the Fed's screwed this up, right? They waited too long. They let the economy get weak. They've let us fall into recession. Um, and I think those are all terrible takes because they don't focus on what really matters when it comes to investing in stocks.
Yeah, it's very, very easy if you're not someone who follows the stock market closely to just sell like when this kind of thing happens. Like I understand why people do it. You know, just people in my it's funny, the only time people in my life who are not into investing ever want to talk to me about it is when we're in this kind of a stretch where
Right.
they're seeing the headlines and they'll say something, like, oh, market's terrible. I should have sold all my stock, like the typical stuff. And even the headlines, like it's frustrating because the headlines make it seem like the smart thing to do right now is to get out of stocks. It's like the headlines want you to time the market.
Yeah.
And I don't know. It's just, it seems like bad reporting. Like,
It's lazy journalism, I
yeah.
guess, this in a certain kinda like using the PEG ratio as lazy analysis. It's,
So let's talk about how you and I have handled this over the last couple of days. Cause I wrote our newsletter this weekend and said how I decided not to do anything on Thursday and Friday. I just thought about buying stuff, but I didn't. And we are now we are past 4 o'clock, so the market is closed. And I did not buy anything today either.
yeah,
But you bought some stuff on Friday,
I
and I'm
did.
curious why you decided to pull the trigger, so to speak.
Yeah, so I've learned that there are times to act and move and be aggressive. And I was a little tongue in cheek because I think you were basically put in there as like I was looking at a bunch of stocks and I was thinking about acting, and younger investor me would have absolutely acted. But current investor me didn't. Turned off my browser and went about my life. And my glib follow up was I bought a whole bunch of stocks. And it's kind of true. I bought one, two, three, four. I bought four different stocks across like five or six different accounts. So I bought a couple stocks in multiple different accounts. But it was like, I don't know, a few percent of my cash, right? So not a few percent of my portfolio, a few percent of my cash. Um, and the reason I made that decision was not trying to catch the bottom, not trying to get a perfect price, but there's a few companies, I'm not going to say names at this point because um, some of the work I do for the Motley Fool, I have some um, disclosure agreements or disclosure requirements about, certain amount of time between disclosing trades. But a couple of stocks that reported earnings relatively recently, in addition to the beat down that we saw for those stocks, um, the end of last week, the stocks were down what I thought was, I guess the shortest, simplest way to put it is it put them within the price that I wanted to pay to add to those positions with a reasonable amount of safety, not over what the stock's going to do the next trading day or the next trading month or even the next year, right? But thinking about holding those businesses long term. And there was a dividend stock that I've been following for a long, long, long time, Jeff, waiting for it to get into um, a price to me that the valuation just made any sense whatsoever. And that's happened just over the past few weeks, and the price started to go up a little bit, and then we saw a little bit of a sell off at the end of the week. And I'm like, you know what? It's time to start that position. So I just acted a little bit timely to start a position there.
Yeah, I got to be honest. If I had a little bit more time today, I might have bought some stocks. But what I've noticed going through my portfolio is, you know, I see something, it's down, whatever, let's just say 5% today. And I remember it was down a couple percent last week too. And in my mind, I'm thinking like, oh, this must be some incredible discount. And this is a little bit what I wrote about in the newsletter. And then I go and actually look at it and look up some valuation metrics. And I realize that it's really not that cheap yet. Um,
Right. Right.
and so,
Right.
and then I find
But
myself
it's
kind
so
of
easy
getting,
to anchor and see the price come down 5, 10, 15% and be like, oh, it's there. It's there. And maybe it's not.
so the fun game for me, and I don't know, like if other people think this is, I think this is a good check on how much something has actually fallen, is just open the stock chart and see where it is now and see the last time it was at that price.
Yeah.
Because
Yeah.
there are some stocks, like CrowdStrike is a good example, that has given back all of its gains this year, pretty much, maybe even more at this point. I haven't looked at that one today.
Mhm.
And so that's compelling if you're still interested in that business. Like, oh wow, it's as cheap as it was in late
Yeah.
2023. Um, but then there's a couple others that have fallen 5, 10, 12% in the last couple days. And I go back and it brings them back to where they were in like June,
Right.
so it's
CrowdStrike's still up 48% over the past 12 months.
12 months. Right. I was just saying year to date.
Yeah, no,
Um,
but that's kind of the point. That's
right. Right.
it has.
So I
This
think
is
that's
Yeah, this is like October price. So it's 7 or 8 months, 9 months here.
Yeah. I think what I like about, I like something that you said earlier, which was that you don't wanna get into the timing the market thing,
Yeah.
right? So, like, if you have done your research and you kinda know the price you wanna pay for certain things, what I would not advise and what I'm trying not to do is just sit here and go, "But it's gonna go lower tomorrow," and then or it's gonna go lower. This is the beginning. It'll be lower
That's
in
a
a
losing
week
game.
because it could, right? But, like so, like, I don't know that I would back up the truck right now and put a ton of money into something just because we had 3 down market days. But I could absolutely see myself, let's just say tomorrow is another red day, buying something that I've wanted to buy for a while, but it's just been too expensive and now it's a little cheaper. And then you know what? If it's cheaper still in a week or two, maybe I'll buy a little bit more and I'll just accelerate the pace at which I bought that, because the market has turned. So I think it's perfectly reasonable to not do anything on days like this. And I also think if you're not someone who has a process in place, it's probably even smarter to not do anything because you will probably end up panic selling or panic buying or reacting to what looks like a big discount and actually isn't. And I think that's where mistakes are made versus what you did, which is had done a ton of research, knew what you wanted to pay, knew the companies well enough that once the market quickly put that stock into the range you were comfortable with, you could execute.
Yeah, no, I think that's generally that's right. And just to kind of build on the whole process and framework thing you were talking about. So for example, if you're a dollar cost averager, like younger Jeff used to be, where he would invest
I still am.
once
I still
once
am.
a week and then once a
Don't take it
month.
away.
Yeah, fair enough, fair enough. But like you would religiously invest every month you were going to buy
Right.
some stocks. That is an excellent, excellent way to take advantage of these dips. And it's the sort of thing where you might see maybe part of your process is maybe you normally invest the first week of the month, and that meant that you didn't buy last week, right? Um, and now things are looking good, and maybe you normally buy on towards the end of the week, and maybe you're looking at the market right now and the sell off that we saw, and maybe the individual stocks you're thinking about, and you're like, you know what, I'm gonna go and buy on Tuesday, or maybe you just split the money in half. So you know what, I'm gonna buy half of it on Tuesday, and then Friday I'll invest the other half, and we'll and it allows you to kind of suck up the quote unquote bad times where maybe you're paying a little bit higher valuation, but then you can take advantage of these opportunities to the downside. They can be worth a lot, they can more than make up for a little bit of overpaying here and there.
Yeah, and I think tied to that, because the one place that we all dollar cost average is in our if we have direct contributions to retirement accounts
Hmm.
like index funds and mutual funds and things like that.
Yeah.
Um, you know, if my if I got paid and that money went into my retirement account this week, I just bought all those index funds at a lower price, and that's going to pay dividends, not literally, down the road when the market
Well,
inevitably
literally, it will pay dividends too.
recovers. I know, but not. I was using it as a figure of speech. Um,
Metaphor.
and I think that's something that I think can help if you're the kind of person that just feels gutted by days like this because you're thinking about how much money you've lost. I think that's another way to think about it, provided you're far enough away from retirement that you have the time to recover. I want to caveat this: if you're a month away from retirement today, probably doesn't feel that great. But if you have the time, you're buying things at lower prices, and that will redound to your benefit. Is that the word? Down the road.
Yeah. So I want to wish you, Jeff. I want to wish you a happy anniversary too.
Oh, that's right. Yes, we. I was away this weekend, and we didn't get a chance to record an anniversary episode, so we can do it now. We hit 2 years since our very first podcast, which was August 3rd, twenty
Yeah, so
twenty two.
Saturday, because when we originally launched the podcast, we were releasing episodes on Saturdays. So Saturday, August 3rd, was the second anniversary of the Smattering, um, the launch of the Smattering, which of course is now Investing Unscripted. So this episode that's going to come out, you're going to hear this before the new episode comes out that we recorded last week. Frankly, we forgot that it was our 2-year anniversary.
Yeah.
So I want to ask you just a couple of questions. Um, thinking about you as an investor in the past 2 years, how has doing a podcast affected how you invest to the positive, and maybe even if there's anything that's been detrimental about it?
That's a good question. I feel like I don't know how to answer it because I feel like if we didn't have this, I'd still be harassing people via text with all my thoughts and feelings, and that those people would probably just be you. Um,
Yeah.
so I my financial therapy has been out in the open over the last 2 years. Um, but I think doing the podcast has helped with all of the mindset stuff
Yeah.
because that's what we've been focusing on, I think, most over the past 2 years, right? We do talk about stocks and we interview people, but a lot of the conversations are about um, getting through tough times, answering the hard questions, as we say in our intro.
Yeah.
So I think for me, it probably sped up the process of me growing into whatever kind of investor I currently am. Um, and I might have still had some of that progress without it, but I feel like it would have been slower. I guess that's probably the best way I can frame it. What about you? How has this process made you a worse investor?
Oh, I couldn't have gotten any worse. No, I'm kidding.
No, that's the most truthful thing you've ever said.
That's probably correct. One thing that it has done, and this isn't, I'm not going to say this is necessarily better or worse, but this is different, is it has certainly slowed me down. Um, I've been like in a positive way. It's like think slowly and then act aggressively
Hmm.
is, um, like I think some of the best, most successful investors, that's how they approach it. You think about the Buffett and Munger approach, spending a tremendous amount of time thinking about ideas, researching, um, and bolstering yourself so that when you see the opportunity, you can act. I think that's one thing that certainly happened is that is that I move at a slower cadence, but then when I do move, I tend to move from what feels like a better position of understanding what I'm trying to accomplish or the business I'm trying to buy or different financial goals. So I think that's been healthy for me.
Yeah, no, that makes sense. Do you think we'll still be doing this 2 years from now?
Absolutely not. Yeah. You?
No, I don't know if that we're going to make it to next week, to be perfectly honest.
Yeah. That's that's fair. Well, um, we'll probably make it to next week, but the week after that it gets a little dodgy.
Yeah, I mean, we already planned next week's show, so we might as well record
Right.
that one.
Right.
Be dumb to throw all that work away. And by work, I mean not much work.
20 minutes on Zoom, really.
All right,
Which means,
let's wrap this up. This is a long, rough cut.
yeah, it is. It is. So, yeah, in summary, a lot of stuff happened with the markets right now. I don't feel any need to be in any hurry, Jeff. I think that's the key. Still got to focus on the goals. That's the main thing,
Agreed.
right?
Agreed.
There you go. Okay. All right. Hey, people, we're just a couple dudes with a podcast. We have great answers for us. Sometimes you can borrow them. You can try them on, but you got to figure it out for yourself. Go get them. Go get them, Tiger. All right, Jeff. See ya.
See ya.